Assalamualaikum. This is Fahad Ali again with a video, and this time the video is all about fiscal policy. This is a video of economics O-levels 2281. Fiscal policy is one of the most difficult topic, one of the most discussed topic by the students, and it's very technical topic because again this is a portion of macroeconomics, and it's very important to answer correctly for macroeconomics in the past paper questions. So if you haven't subscribed the channel, do subscribe it, and let's start with the video. So first of all, we need to understand some of the basic concepts which are very important, and I've just opened the Susan Grant book over here so that you people would be able to see some of the certain things which are there in the syllabus, and these things need to be explained before we proceed on. Number one thing is budget. Again, budget is a term which is used in order to just reflect one of the things that budget is something you control. Let's suppose you budget about something which is related to finance, which is related to money, and which will be utilized in the future time period. So again, it's called budget. Okay. So if we talk about budget, so in this chapter, the budget word is connected with the budget of the government because we are talking about the whole country, and this is macroeconomics. So again, we'll be concerned about the budget. So in this budget, we have either a budget deficit or a budget surplus. Let's suppose if you're planning about two things. Let's suppose if you are planning some expenses from 1 lakh PKR rupees maybe, okay, and you're able to just fulfill all the expenses, and you have saved, let's suppose, 10,000 out of this 1 lakh. So again, you are in a position where you can say we have a budget surplus. Okay, this is one thing. Second thing is that you again had a budget of 1 lakh PKR, that is rupees, and then you were not able to just fulfill all the expenses which were important at that time, and you had to borrow from someone $10,000, 10,000 rupees, sorry, not dollars again, because we are dealing with Pakistani rupees. So if you have to borrow from somewhere and you're not able to meet the requirement of your expenses, so again it will be a budget deficit. Deficit word is used when you're not able to fulfill the requirement out of the available amount which is there. And the word surplus is required. Surplus is used whenever you are able to fulfill all the expenses within the boundaries, within the limit which is set by the government in this situation. So budget surplus and budget deficit. Budget, a control which is put on the amount. Let's suppose you had a lot of money in your pocket, and you will not be able to control everything until unless you make a budget and you plan accordingly, because again you would have gone to grocery, some supermarkets, you would have observed this thing that you plan something, you have a budget with yourself, and after taking out the budget you just plan things accordingly and you just skip some of the items you observe over there. So I hope I have explained the budget word and the budget deficit and the budget surplus, and the last thing is national debt. National debt means the debt of the business, that is the borrowings which is done by the country and which has to be paid by the country again when the country has done borrowings. And one of the most important areas from where we borrow is IMF. Again, I'll be talking about this in this video. The reasons for the government spending, why government spend. Whenever the government is spending, they want to spend just in order to influence economic activity. They want the economic activity to boost, to improve the economic activity. So that is the main purpose. When the economic activity will be increased, let's suppose government is spending on building some roads. So when the government is spending, they will be paying some workers, and the workers are being paid. So again, workers would have some amount to spend on certain goods, and because of spending something on certain goods, what will happen? Our economy will be going in a flow. That will be a better word. What I can say is that economic activity will grow in that scenario. So that's very important over there. Then the second thing is to reduce market failure. How do we reduce market failure? The government spends on public goods. As I have already told you, if you haven't seen the video of market failure, do watch the video. Public goods are those goods which are non-excludable and non-rival. It means you cannot exclude anyone from its use. I gave you the example of street lights. You cannot exclude anyone from that. So again, the government just spends on that. And the third thing is to promote equity. Again, you promote equity means you give equal share to everything, equal share to some. Again, it is written down that governments provide state pensions, subsidize housing, and these things are given to the people because the government is there to for the welfare of the people. And the last is to pay interest on national debt, which is again, it depends on the country. If the country has borrowed from somewhere, so they have to pay the international debt. Let's suppose if we talk about IMF, but they are not talking about IMF, they are not talking about someone who has to be paid outside. They are talking about someone from whom the government has borrowed and it is inside the country. because it is talking about the government spending. So inside the country, if you pay someone after taking a loan, then it will be counted as uh, national debt. Okay. And again, there's one thing which is said as multiplier effect. In the A levels economics, you would learn this term, but again, in the O levels economics, it's very important. Multiplier effect means that if you spend 50 rupees for purchasing something, so again, this 50 rupees will be spent by you for purchasing one item. So the other person who is receiving 50 rupees, what he will do, he will again purchase another item from somewhere else. Okay, so this 50 rupees will create a chain. This was spent by this person, and this person, the B person, this was A, B and C. The second person received the amount, and this second person has spent this amount on some other commodity. So again, a 50 rupees note will have a multiplier effect, will have multiple effects, and in the end we will count the expenditure of rupees 150 rather than rupees 50. This is called multiplier effect. When you will have many effects, when you will have more than one effects of one transaction, that is called multiplier effect. That's something good in the economic activity. Why do we levy taxation? Levying taxation, it's very important, just because the first thing is to redistribute income from rich to the poor. This doesn't happen in Pakistan because there are a lot of laws which are violated over here. So the first point is not valid in Pakistan, but again, many of the times it's very important because the intention of the government is to redistribute income from rich to poor. The rich is earning more and more than what he or she is requires for their survival. So that's why what the government does, the government taxes the rich in order to distribute the income again to the poor who is not able to survive good in those circumstances. Second is to discourage the consumption of demerit goods. You would have observed this thing. There are certain cigarettes or other items which are addictive in nature, and they are taxed so that the government can earn, and the government can also discourage the consumers from purchasing more of those goods, so that the hospitals should not be filled with a lot of patients over there. To raise the cost of the firms that impose cost on others, again, there are certain things which are causing pollution. So pollution, this thing has been discussed in the topic of market failure. If you haven't seen the video, do see that video. Market failure, again, is someone is doing more pollution, so the government will put more cost, put more taxation on that person, so that they should be discouraged. Next point is to discourage the consumption of imports and hence protect domestic industries. Again, if you see the cars, like we have several cars which are very expensive in Pakistan. The reason is that because the government has imposed some sort of taxes on that, and when the government is imposing taxes, so they want that good to be more expensive for the customer. But again, in Pakistan, what people are saying that if it is expensive, then most probably it will be of good quality. So that is something which is a misconception in our people. And when the government taxes certain products which have come from abroad, so people tend to buy those products just because they are expensive, so their quality will be good. This is the assumption of local people. Last is to influence economic activity. How do we influence economic activity? By putting some taxes. When we put tax, what happens? We just try to influence the business in order to just make it better. Maybe we are putting less taxes on those businesses who are providing employment to people, those who need employment in that particular area where there's high unemployment. So that's very important. Then we have the categories of taxation. What are categories of taxation? There are two broad categories. Either it is a direct tax or indirect tax. Direct tax, it is levied on income. When the income is taxed, so it is called direct tax. When you deduct tax from your income, so it is called disposable income. Disposable income is the income which remains after the direct tax has been deducted. Second is indirect tax. We pay indirect tax on commodities. This is not provided on incomes. This is provided on commodities. Let's suppose you purchase something, you pay indirect tax, value added tax, VAT, sales tax, general tax. These all are examples of indirect tax. Then we have three more categories. One is progressive tax. Progressive tax means one which increases with the increase in wealth. Let's suppose if someone is earning 5,000 rupees, so he will be paying 10%. If someone is earning 50,000 rupees, so he will be paying tax of 20%. So it keeps on increasing with an increase in income. That is called progressive tax. Proportional tax, again, this means that the income is taxed according to the amount. Okay, so in such a way that the amount is adjusted and the percentage adjusted according to the income. And the last one is regressive. Regressive means when you earn more, you pay less tax. Okay, let's suppose a person who is earning 5,000 rupees will be paying 10% tax, and a person who is earning 50,000 rupees will be paying 5%. And what is the justification about this? The justification of this thing is that the government doesn't want to discourage the person who's earning more, so that the person who's earning more should be earning more, so that he or she should be able to just support the economy. So that is the main purpose, and that is the main reason why the governments just try to do this regressive taxes. There are some countries who follow regressive taxes in the world. Then there are main types of taxes: income tax given on income, corporation tax given on profits of the companies. The last one is capital gains. Capital gains is made when an asset is sold. This is also paid by the company when an asset is sold, when a share is sold, and like these things. So these there are capital gains. You gain something, you get a profit after selling selling that thing, and you have to pay tax. And the last one is inheritance tax. Again, if you got some property from your ancestors, so again you will be paying tax for that property. Common types, you can just read these indirect taxes. Common types: sales tax, excise, custom duties, licenses, and these things. These all are examples of indirect taxes. Local taxes, again, it is levied by the government about the road, the parking, and these things which are important. Principles of taxation, again, this is not followed by every other country, but these are very important to remember. There should be equity. Equity means that it should be fair enough to be taxed every other person in such a way that it should be equal. It should not happen that one person is given more tax to pay, and the other person has got free from paying any tax at all. So that should not be happening. Certainty means that they will be able to calculate the amount of tax to be paid by that person, by to the business, to the government, sorry. And the third thing is convenience. Tax should be easy to pay. Maybe the online systems could be utilized. The economy should be made in such a way that the tax could be collected easily. There should be flexibility. Flexibility in such a sense that if the economy has slow economic activity, so there should be less taxes, so that economic activity could be boosted in that particular scenario. And the last is efficiency. Efficiency means it should improve the markets. It should not happen that it is discouraging the production of certain goods and services, and the and those, what we can say, industries are being closed down. Impacts of tax, it all depends how much tax is paid. It all depends on the PED of the customers. It all depends on the price elasticity of supply. These topics are interlinked. Price elasticity of demand: if you're taxing something and the customer is thinking that it's something which is a luxury, let's suppose you're taxing the air conditioners, so it is a luxury. When it is a luxury, the consumers will be buying it less. Okay, but if we talk about some medicines, if you're taxing it more, so again, whatever the scenario remains, the customer has to pay for the medicine because he or she will be ill at that scenario. Price elasticity of supply, again, if there is more taxation, it all depends on the supplier, whether the profit margin is justifiable, so that the what we can say, so that the person who has to pay or who has to purchase or supply in the market will be able to do it or not for the price elastic supply. This is inelastic demand. You can see this thing. This is the impact, the shifts. This shaded area will tell you the taxation. Why? Because this is the supply curve, and this is going left hand side. So when the supply curve goes on the left hand side, it means it is decreasing. And again, it is elastic demand. Elastic demand means your demand is remaining, is getting less. So again, the shaded areas will tell you how much taxes are there. Then we have impact of direct taxes. There are certain impacts of direct taxes. You could write more than one if there are more taxes of income. So again, what will happen? People will have less amounts, and when people will have less amounts, so again they will be able to spend less. And when they are able to spend less, so there will be less economic activity. And because of less economic activity, we will be able to sell less. And again, businesses will be closed down because of less economic activity. Indirect taxes impact: there will be less production, and because of less production, there will be less demand of workers, and when there will be less demand of workers, they will be able to purchase less, they will be able to earn less, and when they are able to earn less, so they will be able to purchase less, and ultimately it will be a spiral which will go on until unless the economy is corrected. Changes in taxation, again, it all depends on the government. So you have to read it out on your own. Fiscal policy and the budget. There are two types of fiscal policies. One is expansionary policy, another is contractionary policy. Expansionary policy means you want people to spend more. So what you will do, government spending will be more, which means that government will spend more amount on building roads, on building defense, on building hospitals. Okay, it will be more. And government will reduce the direct tax so that people will have more money in order to spend more in the market. But if it is a contractionary policy, so the government want the people to spend less. So what they will do, they will reduce government spending and ultimately they will increase direct taxes. And again in Pakistan at this stage there is contractionary policy which is being followed. So again these are the most important things you have to read from this. Effects of fiscal policy on government macroeconomic objectives. Government has four objectives, you know this very well: employment, output, and balance of payment. Output is also said as GDP of some of that, and less inflation, that is low inflation, sorry, not less. So low inflation, these are the objectives. And again this is aggregate supply curve, this is aggregate demand curve. You see this, that the aggregate demand will increase because of an expansionary fiscal policy. You want people to buy more, you want people to spend more. So when you want people to spend more, so again it will be an expansionary policy and the demand curve is shifted on the right hand side. So I hope I have explained this very well, and if you haven't subscribed, do subscribe the channel and then like this video, share it with your friends, comment below if you did not understand anything, and like my Facebook page which is Fahad Ali. So let's see you in the next video. So till then, goodbye.